What's up, everyone? We are live with HMB Live. Today is Tuesday at 11 a.m. This is where we meet. Tuesday, 11 a.m. We do the HMB Live show right from our office in Columbia, Maryland. Jason Balin, I'll put my name on the screen. Chris Haddon, I'll put his name on the screen. And we will get rid of this here logo. So it's just two of us side by side. If you're just tuning in, thank you for spending a few minutes with us. We do this HMB Live show at 11 a.m. Every Tuesday. It's a lot of fun. We talk about real estate. We talk about marketing. We talk about finance. And we talk about general business. So if you have any questions related to those topics, it is an open format. Feel free to comment below and answer and ask any questions that you have. And we are free and we will be answering them. We do have a topic in play that we start with just to get things moving, just to kind of get your brain thinking. Today we're talking about accounting for your money and tax advantages of real estate investing. And one of the reasons we thought this would be an appropriate topic for this week is because we're doing our monthly meetup group. It is at Nottingham's in Columbia, Maryland. The third Wednesday every month. It happens to be tomorrow, and we have a local attorney or local CPA named Jeff Cohen who is stopping by to speak. Very, very qualified on this subject. So make sure if you're in the area, doors open at 6 p.m. Come by and check it out. Cool. So any questions along the way? Like I said, feel free to add them. And if you want to be a guest on the show, I will put the link here right now. And just copy and paste that link into any Google Chrome browser, and you can hop in and check that out, or you can do it from your iPhone, whatever works for you. But I comment below. So any questions you have, feel free to add. So let's dive in, Chris. So first off, one of the things that we've kind of talked about in the past, whenever we talk to other real estate investors, whenever we talk to business owners. One of the most important things is if you cannot count your money, you cannot be in business.
At least not in that business, right?
Yeah.
Yeah, we've been saying that,
at least
for a long time. And here's what we mean by that. You have to understand the finances of whatever business you might be in. It just so happens that real estate, owning assets, is a little bit more complicated accounting-wise than many other businesses that are just straight income expense. You make some money, you have some overhead and a bottom line, and that's it. But whatever business you might be in, you have to be able to count the money. That does not mean that you need to be able to do everything a CPA does. You don't have to be able to prepare tax returns. You don't have to do all your depreciation calculation and everything else. There are certain things that only a CPA should be doing, for sure. But you need to understand the dollars. If you don't have a perfectly clear picture, if you don't have the exact number, what you made or lost on a real estate deal, on a rental property, on a flip, whatever, you can't be in that business, very frankly and very simply. Isn't that right?
Yeah. I mean, you don't know if you were profitable or not. And let me tell you that every single real estate investor out there, they're extremely emotional and they're related to what they have in their head. They work their numbers in the head of like, oh, I bought this for
optimistic too, right?
Yeah, that's the right word. Optimistic's the right word.
Okay.
They're optimistic about what happens. All of a sudden a deal starts going bad and it's like, yeah, we're still good. We're still on top. You're not. And you will be very, 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 very surprised what your numbers look like after you get them on paper. And people are scared to put their numbers on paper because they don't want to, if it wasn't a good transaction, they're scared to see that they could potentially have taken a loss.
Right. Or that they didn't make nearly as much as they thought they did, which we see with HMB clients all the time. I mean, it'll probably shake out at some point when it's time to prepare taxes or whatever. But day to day, month to month, they're often going on just like a few numbers sketched out on a yellow pad or a whiteboard or whatever, or maybe just in their head, even worse, trying to calculate their profit or loss on a deal, which is scary, which is super scary. And that's why we've been saying forever that if you can't count the money, you can't be in the business.
And how can you even make business or financial decisions related to that project or your company if you don't even know what the darn numbers are? It makes zero sense. For instance, let's say your contractor comes back and says, hey, you're going to need some more work to get this done. Okay, well, how do you even know you have that money in your budget? How do you even know if that will financially put you over the next step in order to sell the property for more? it's all very, very common sense things, and people think it's hard to account for their money. Well, you know what? Accounting for your money is pretty darn sexy, if you ask me. I'd much rather counting the cash than, counting how many, nails I need for a freaking property.
Yeah, counting the dollars is much more appealing to me as well. All right, let's segue a little bit. You want to talk about what's going on tomorrow night, and then we'll touch on some of the subjects we'll be covering?
Yeah, so tomorrow night we have Jeff Cohen. He's a CPA locally in Baltimore. I'm pretty sure he's got some DC clients as well. But more importantly, he works with a lot of the bigger investors here locally in most of our markets. He's a good CPA. The reason that we brought him on is because he works with a lot of our clients, and he works with a lot of other advisors that we have in our meetup group that are doing deals. They're active. They're doing tons and tons of deals, and they have him ask him related to tax advice, and they're asking him related to proper bookkeeping and proper entity structuring and everything else in order to make their businesses run smoothly. He's a partner to a lot of these guys. So we brought him in. The doors open at 6 p.m. We're at Nottingham's in Columbia, Maryland. Nottingham's is pretty darn equal to DC and Baltimore markets, so you don't really have an excuse what market you're in. Come in. It's good.
Halfway in between for sure.
And with schools being out in the summertime, the traffic is not bad. So make sure you're there 6 p.m. at Nottingham's. He's going to go over all of this stuff. We've got some good bullet points of stuff we wanted to talk to him about just from questions and comments from clients that we have. But more importantly, it's an open mic. We don't sell, we don't pitch. He's not selling anything. There's nothing to buy. So it's free, good local content from real guys doing deals and real investors and real service providers out there in the marketplace. So bring all your questions because there's tons and tons of availability and time to talk. So again, ask any questions that you have on this show. We do this show for about 20 or 30 minutes every Tuesday at 11 a.m. And, the show's for you. Any questions that you have, Chris and I always joke about this. If we're not talking about this on camera, we're just talking about this in each other's office. So we might as well involve everybody and kind of have a live look in, because this is stuff that we love and we're constantly talking about it. All right. And also, if you want to be on the show, feel free to click on this link if you want to be live on the show, or, just ask a question. That's fine too. So let's dive in a little bit about business and entity structuring. And again, we're not CPAs and we're not attorneys. So ask your advisor, ask your CPA, or ask your attorney what works best for you. But as we all know, there's a lot of different business entities, types of structure. You could be an LLC, you could be a partnership, you can be a C corp, you can be an S corp. You can be an LLP. There's a lot. You can be a sole proprietor. There's a lot of different structures related to it, related to your situation. And one of the frustrating things that I think comes up when you talk about this topic is you talk to different people and they give you different opinions, because everyone has a different opinion of the proper way to structure it. And what works best for our company maybe not work great for your company. So that's why it's important to get with somebody. And, I like to use our service providers, not for them to tell me what to do, but to get their opinions, and they get multiple people's opinions of what they think is best and why. Not like do it this way, but it's do it this way and why. And then I can make the decision, or Chris and I can make the decision of what works best for us as a company and individually. And keep in mind, a tax attorney, or I'm sorry, a CPA and an attorney may have, different opinions, because you got the tax side and the tax advantages of real estate investing, but then you also have the legal side of things.
Yeah. Very true. And just backing up for a second, ever since we got into real estate investing anyway, I've heard varying opinions on a few things, on the best entity for, whatever you may be doing. Like, okay, so a couple different kinds. The main ones, I know you mentioned most of them, but if you're talking about an LLC filing as a partnership, an S corp, or a C corp, which are the most common ones in our business, and which entity would be best based on what you're doing, buying and holding rental properties, doing wholesales or flips. I've heard a lot of different opinions from CPAs, and they all make sense at the time, right? Like ever since we first started going to conferences years and years ago, and just first getting started, I've heard varying opinions on that. And also for people who are actively buying and selling and also have a rental portfolio, which is many people in our meetup group and in our in our sphere, whether or not you should do that in the same company or in more than one company, if you should separate your flips from your rentals. I've heard so many different opinions on that. I'm very curious to hear Jeff Cohn's tomorrow night.
Yeah, absolutely. And, you know, a lot of people we talk to, they use a different entity for every property that they buy. So be it. I mean, different people, you know, different strokes for different folks. So again, I'm not here, Chris isn't here to judge if you're doing it the right way or the wrong way. And, you know, Jeff Cohn may not be telling you the exact way, but I would use his opinion and I would use his experience to lead you down a path that, hey, this makes sense to me. I'm going to go this way. The only thing I can tell you, and this is not giving you any legal or tax advice, is don't be so proactive in jumping in to set up an entity just to set up an entity. Like, it doesn't impress me or anyone else that you have 10 business entities or you're getting 10 K1s. Like, that doesn't matter. If Chris and I could have it our way, we would love to have a one business entity and that's it, because they are a pain in the neck. They cost money to the state. They cost money to do reporting. Everything costs money related to them, and they're all over, you know, and they're a freaking mess. You have one for this, you have one for this. So in a perfect world, we'd love to only have one business entity. We don't have that many. We have a few, but I'm sure there's people that are similar, have a similar operation to us that probably have 15 of them because they, you know, get a high from thinking they need all these darn entities.
Yeah, that I feel like that's kind of a newer investor, newer business owner sort of thing, and that goes away because, like Jason said, like, yeah, you have to deal with the accounting for each one, bank account, little things you don't anticipate, like doing the personal property return for the state. And even if you don't have any business going on, you have to file a tax return both with the feds and the state. Like, there's stuff that goes into it. There's headaches. There's costs. So yeah, just having a business entity to have a business entity, yeah, not
no fun. Cool. All right, so let's jump in a little bit. Let's go through some of these other points. Any questions that you have, feel free to comment below. Happy to talk real estate marketing and finance business. If we're not talking to you on camera and on this Be Live through HMB Live, we're just going to be in each other's office talking about this stuff anyways. So self-directed IRAs, I'm still surprised that there's so many people out there, especially real estate investors, that are active investors that don't understand or aren't familiar with a self-directed IRA. There's a lot of people out there that have money in a retirement account or 401k or something just because they worked at a job and they were contributing over the years and it was growing. And you're able to actually self-direct that, just like you call it, meaning self-direct it. You can determine what type of transaction or what type of investment you want to put that into. It's got to be a qualified transaction, and we can go into details in that in the future. But just kind of the purpose of this is the understanding that there is ways to take money that you have in some sort of retirement account. Chris and I do it regularly with the majority of our retirement money and put them into self-directed IRAs. So you can either invest in deals, rentals, flips, commercial buildings, private notes, whatever the case is. But understanding the concept of self-directed IRAs is so darn important. Yeah.
So, I mean, to keep it very simply, if you have an IRA or a 401k, you're very, very limited in what you can invest in. A certain plan is going to have, okay, you can choose from these 5 or 10 funds. And they're all very similar. They're actively managed funds with high fees. They're in stocks or bonds. And that's basically it. Right? Self-directed.
Yeah, you have limited control of what you can put them in.
Yeah, very, very limited things. Out of the hundreds of different kinds of things you could invest in, you have a choice of like 5 or something. Okay, so the self-directed world, which is completely different. Like, different custodians, there's companies who do self-directed, and there's traditional sorts of retirement account custodians. They really don't overlap. So your Vanguard, your Merrill Lynch, they're not going to have self-directed options, at least not from what I've seen. So if you talk about companies like Pensco and Equity Trust and Mid-Atlantic IRA, they're very niche in what they do in the self-directed IRA. And being in real estate and knowing how deals work, what you can make, what your risks are, can be a very, very good thing for your retirement savings. The one thing I would caution, and of course, self-directed IRAs, just like everything else that we've mentioned before, it does require professional attorneys, accountants, what have you. The one thing I would recommend is that there's an issue called self-dealing. So to keep yourself away from that, I would just plan to have your IRA do transactions that your IRA does, and you personally and your company, you do transactions, but don't mix the two, right? Just to be safe, just to be careful.
Yeah, exactly. But get with your custodian and figure out what's a qualified transaction or not. It's a good way to either, let's say you don't have enough money to get into a deal. I talk to borrowers a lot that they have, let's say they have $100,000 in a IRA, they convert it into a self-directed IRA. They don't have the $100,000 to buy the deal, but listen, you can leverage it up with a hard money loan, get $50,000 from us, $50,000 from your IRA, then it gives you the ability to get into that deal or whatever the case is. So
for sure,
we'll be talking about that. We'll be talking about that tomorrow night too at the meetup group. And you know what? Why don't I just mention the little meetup group? Meetup group. What's tomorrow? July 19th?
July 19th, Wednesday, July 19th. Nottingham's in Columbia, Maryland.
Free. No pitching, selling, or gurus. I'm going to comment that. Junk's right there. All right. So the final thing we're going to talk about, and this is big, that a lot of people probably are coming tomorrow night to learn a little bit more about, is depreciation. Depreciation is an interesting thing because it differs depending if it's a residential property, if it's a commercial property. Having, not necessarily an expert structuring this for you, but at least communicating the best way to depreciate some of your assets is huge.
Yeah, let's back up for a second, talk about what depreciation is and why it can be such a good tool.
Do that. Something just popped us offline, so do that again.
Okay. All right. So depreciation. First things first, depreciation is what makes real estate one of the favorite types of investments from wealthy people for forever, for hundreds of years in the US. And here's why. Here's the concept behind it. Depreciation means you're going to be taking a write-off, a write-down on your income based on this particular asset depreciating over a period of years. We don't have to get into the exact calculation, but the idea is that you can get to a point where you are cash flow positive, meaning your rental income is more than your expenses for a given property. Yet, because of depreciation bringing that income down, you're actually showing a tax loss. So you're taking a write-off at the same time you're actually making money. Totally legal, totally common, something that Jeff Cohen is going to cover tomorrow night. But holding investment real estate, income properties for the long term, has been a super, super good strategy for wealthy folks forever. And that's something that we focus on in our own business and that we certainly recommend that other investors do as well.
Yeah, absolutely. Yeah, I think that's going to be a popular topic. Oh, man, I got an echo on mine. You hear me as an echo?
No, I hear you okay.
All right, I'm going to take these headphones off while I talk then, because I keep hearing myself as an echo. So I think one of the popular things, like we just said earlier, that Jeff's going to talk about, like I'd like to actually dive into that a lot with a lot of people, just to understanding the importance. I mean, I think so many people in real estate investing, they just find the flipping part sexy. The sexy part of flipping is, you involved in a lot of transactions, and it's for the most part pretty short term and quick capital. But just because it's short term and quick capital doesn't mean it's necessarily good money. I mean, you're paying ordinary income, you're paying normal capital gains, short term capital gains on that money.
And the highest
so depending on your depending on your tax bracket, if you make $30,000, you may only keep half of that. So it's one of those things that, we've always liked to diversify our portfolio and have a little bit of everything going on. But I think if someone can, if Jeff's able to shed a light a little bit more on depreciation and how powerful that is, it works. It'll be great. Cool. So unless you guys have any more questions, feel free, comment if you have any more questions, or we're going to, get this thing wrapped up. Again, tomorrow night, we're doing our meetup group. We meet the third Wednesday every month. We do it at Nottingham's in Columbia, Maryland. Actually, you know what I need to add for you guys is the meetup link. Best way to go is hardmoneybankers.com/meetup group. It'll redirect you right to the meetup site. And right from the meetup site, you can register. All we ask is if you're planning on coming, do please register. And the reason is we get about 200 people or so that register, and then we get about 130 to 150 that ended up coming. That just ends up being what it comes to. And we want to make sure we have enough seats for everybody if we need to bring more in from storage and things like that. So please RSVP if you come. And yeah, I mean, that's for the most part all I got today, Chris, unless you want to add something.
Yeah, just to wrap it up here. Look forward to seeing everyone tomorrow night for sure. And, whether or not you view accounting and counting the money as an appealing and sexy part of the business, it should be. And you should get there over time. Even if today it's not, maybe you don't have a whole lot of transactions going on, it's not the most appealing thing to you, get your stuff in order before you start doing deals, because it's going to become important immediately and should stay that way. So if nothing else you take away from this, get into accounting and reporting, because
if you can't count the money, like we started this, if you weren't here earlier, if you can't count the money, you cannot be in business. I promise you.
Yep.
do it the right way. It's the only way to go. All right. Well, that'll work. Check you later.
Later. See you tomorrow.
Next Tuesday, 11 a.m. and see you at the meetup group tomorrow night.